Welcome back to the Property Trio, the property podcast for the sophisticated buyer, and I'm joined with Dave Johnston and Cate Bakos as always for this market update. Good morning, guys.
G'day, Mike. Good to see
Morning,
you,
guys.
Especially Dave. He's out of the caravan.
Out of the caravan.
He's
It's
out of the caravan
excited
and back home.
Back in Melbourne. Very excited to be in Melbourne. The kids were busting to get into school and see their friends. And it's nice to be home for a few days.
Nice to be sans kids, right?
Yeah, it is actually. It's nice to have a bit of silence. We've got plenty to get organised too with our renovations.
Yes, I don't envy you on that one. But while you're back and you're refreshed, we're going to put you to work because we need your brain bent on the month that was August. So we're doing our August update. We've got the monthly, they're still calling it core logic, are they? Or cotality figures?
Cotality now, I think we're supposed to call it.
Yeah. I'm going to call it coitality because that just tickles my inner 8-year-old rude person. So it's a bit of a mixed bag across the country. Interesting to see the perennial performers of, let's say, 23-24, Brisbane, Adelaide and Perth still continuing to deliver, with Brisbane doing 1.2% for the month, actually beating Darwin, that has been the runaway favourite, and 1.1% for Perth. I mean, Adelaide at 0.9, that's still a strong market. Darwin's leading the nation on an annualised basis, but it does beg the question, how much longer have we got these markets to run? Cate, I want to start with you on the Melbourne side of things. Again, probably a disappointing month print that doesn't really match what's happening on the ground. We talked about price segmentation in a previous episode. Is that explaining it 100% for you?
Not really. It is a lower figure than it feels, and we've talked about this before. I carry bias because you'd expect a buyer's agent would be selecting properties that are as close to flawless as possible, and featuring all of the things that buyers love. And so it's not surprising to note that I'm attending auctions for properties that I'm bidding on that have a stronger representation of bidders. So the competition levels that I'm feeling aren't across the board because I'm not targeting property that has minimal interest. The other thing that I'll note is we've had a significant change in our competition levels and the prices that I'm seeing properties achieve since the last rate cut. And this data doesn't capture that. This data only captures a portion of it. So I'm going out on a limb, but what I will say is this time next month when we have our September market update in October, I'm expecting Melbourne to be over 1%. So wow. Big prediction, but the dynamic has changed markedly and it feels really aggressive out there and everyone's saying the same thing.
We do have segmentation data. So the quarterly change in stratified hedonic dwelling index 3 months to August is showing the actual the 50th percentile or let's say the middle set of values actually growing by 1.4% compared to the lowest quartile at 0.9%. So that is kind of inverse evidence for the fact that it's just the cheapies that are selling and that's what's dragging the prices down.
It's interesting that you bring this up. I love this chart and I've watched that change over the last 2 or 3 months and it has got particularly noticeable that it is the middle of the market that's really performing well. And what that really is upgrader activity. And upgraders will often be the ones that are most emotionally fueled about a property. They've got a genuine reason for wanting something. In a lot of cases, it might be a baby on the way. It could be getting kids into the school year. It might just be that the walls are closing in on them and they need a bigger house. But that segment will always push and particularly push to their limits. Now, we've had a couple of rate cuts and the most recent one in August. A lot of upgraders have taken action. They've gone back to the bank or the broker and they've said, how much can I borrow and that is their hard limit. I watch
Mm.
people bidding at auction and they have a number written down, and that's as much as they can get their hands on. So it's no surprise that that segment of the market is pushing hard.
We'll come back to that because there's some very interesting segmentation data for Darwin, and you referenced lending and listings in your response there, and we've got some meat on the bones for those particular topics. Cate, when we look at the change in dwelling values to the end of August, obviously we can look at the last month, the last 3 months, and the last 12 months, and we can get a little bit more granular with the Cotality data that's showing us the regions versus the capitals and some particular regions leading the charge. Were there any standouts for you in that data?
The standout is that absolutely everything except Hobart in the last 3 months is positive. So leading the charge is one thing, but to have the entire nation in sync with growth is quite phenomenal. And Hobart's loss of value is marginal, if you ask me. It's 0.2% for the past month and 0.6% past 3 months. And it's had a bit of a disappointing overall performance for the year at 2.6%. But aside from those blips, everything has been performing really steadily and some really strongly. It's unusual to see, green ticks across the board, Mike. We're used to seeing markets performing in different cycles, and it doesn't seem to be the case right now. And we haven't got record low interest rates or one key thing across all of these environments. It's really a signal of a healthy market.
Yet the sentiment is a little bit kind of lumpy when it comes to what people's expectations are for household budgets and the economy as well. But luckily, stick with us and we've got all of that data. If we look at, I love when Cotality do the graph that talks about the previous peak of the market. When we look at all of the capitals, there's only 3 places in Australia that aren't technically at the market peak. That's Melbourne, Hobart, and Canberra. And interestingly, all peaking sort of within 2 months of March 2022. And it's really interesting to look at the 5-year data because Melbourne is so far and away behind every other place. You look at Sydney's 36% growth in 5 years. We've got places like even Hobart, which has been depressed for quite some time, 28%. Front runner at Perth, 81.9, but Melbourne still trailing there at 16.8. Anecdotally, the seat of the pants feel is that it's booming and there's things happening. Obviously, you've sort of prefaced where you're in that competitive segment, but it's still should have tremendous upside, shouldn't it?
Well, Melbourne's the closest to reaching peak out of those 3 that have underperformed. We're 3% off our peak in March 2022. So if we can get 3% movement out over the next few months, we'll reach a new peak. And I sound like I'm making excuses for my home city that's underperformed, and I'm not. I'm just making that point. Canberra will be next to follow. Interestingly, it's Hobart that's still over 10% away from its last peak. So what that says to me about Melbourne is, yes, we've underperformed and it's been miserable, but it hasn't exhibited that same volatility. We've, been consistently underdoing it for a lot longer. So a lot of people are anticipating mean reversion kicking into place. I'm not going to subscribe to that. But what I will say is the tide has definitely turned and it feels quite different. And a lot of that relates to stock. And we'll have a talk about that in the next segment. But I too like this chart, Mark, but I do notice that 3% off last peak is a small amount of growth in the scheme of things.
It's a market that's been much more resilient than, say, Hobart. We're talking 10.4% from the peak of the market. And if we look at national downturns, we've never seen one in recorded history of greater than 10%. We don't get double-digit downturns. Typically speaking, they sort of peak at around about 7%. So that sort of speaks to the resilience of Melbourne. And getting back to you, Dave, with those 3 horsemen of the apocalypse markets of 23, 24, Brisbane, Adelaide and Perth, is it a surprise that these are still the perennial performers and still delivering these gains?
Yeah, I think it's a surprise. It's not often you get, let's call it a dead cat bounce, where we get the fall in price growth for a few markets that have really been flying for a long period of time, and then they rebound again like they have. What's really interesting to note in the quartiles is for those three cities, the best performing segment is the bottom 25, 25th percentile of properties. So in other words, the lowest price properties. I think that possibly is telling us a little story. We know often at the end of a cycle, it's the lowest value prices that are showing the strongest growth. So possibly we've got potentially the latecomers to the party, the bottom feeders, shall we say, who are getting into the market, but they're the those with the shallowest pockets, the least amount to spend, and that's potentially driving this push because the upper quartile highest price properties are the weakest performing in all three of those capital cities. So that potentially is telling a tale that this may not last for the longer term for those three capital cities. And if you contrast that to somewhere like ACT, where you've actually got the upper quartile who's performing the strongest, again, that often leads a rebound. Now, we know there's the stability of federal government. You know, we know ACT tends to perform better when there is a Labor government in. They had a landslide victory. So possibly that is some signals for the ACT, which we've talked about a few times in recent months, that it is on the rebound. So, yeah, look, it is a surprise for me, and maybe that segmentation is a bit of a telltale sign that it's not as sustainable as the previous run was. What do you both think?
Yeah, it's an interesting one, isn't it? And I circled that on my printout. Brisbane, Adelaide, and Perth, they're all doing that same trajectory where the bottom end of the market. So, you know, perhaps the upgraders have done their job. The prestige buyers aren't seeing value. So it's the bottom end that's driving it.
I've got a different
the
theory.
deeper pocketed investors have moved to other cities.
I think we've got investors in those states that have had equity gains and they're wanting to buy property. And not every investor targets a high capital growth, higher priced property. A lot of them are looking at yields, and all of these areas have reasonable yields on offer, particularly Perth. But they tend to go for the lower quartile, especially the early investors. And, you know, looking at Perth, there's no surprises here in this data. Their market hasn't performed in ages. It's not been an investor magnet for over 15 years, and all of a sudden it is. So you'll attract a lot of first-time investors who are dabbling. And when people dabble, they spend less. I think that's exactly what's happening here.
Interesting.
Yeah. I think Perth is the one with the potential most upside because its medians are still so historically affordable. Its prices are still quite affordable. Plus, you know, it's the state that's got the most going for it in terms of economically, in terms of surpluses for the government, in terms of the lowest unemployment rates. So it does have a lot going for it.
I was speaking to a Perth buyer's agent the other day who said that there's a real transition from projects going from construction phase to production phase. And there's an argument to say, well, where is the greatest job opportunities? There might be more activity during the construction, but when it's production and maintenance, it's less lumpy, it's more uniform. So he's expecting that there'll be a little bit less volatility and we might not necessarily see the peaks and troughs that we have over time. It'll be interesting to watch to see if that changes. Cate, I prefaced the Darwin market in terms of those quartiles, and very, very interestingly, a different shaped sort of quartile grouping there to other markets. Have you got any ideas as to why it's so uniform across the
I
market?
do. So their price range is tighter than other capital cities, particularly, the biggies where we have small units and then we have, 10, $20 million houses. You don't have that number of high priced houses in Darwin. Of course, there's certainly some gorgeous houses that outstrip all of the others, but you've got a lot less of a range, and investors and owner occupiers have been active in Darwin, but certainly its lion's share of activity has been investor activity. But they're discerning. Investors are looking at much lower price points, and so if an investor has a comfort level around spending 800,000-900,000, which in our market they certainly do if they're looking for a house, they might be prepared to spend that in Darwin and get something that is a little bit better than the average. So we're seeing an appetite to spend a little bit more than the median price. And if we scan back to Darwin's median at the moment, Darwin's median house price is 553,000. So if you can get something awesome for 700 or 800, why wouldn't you? And I think that's what's happening in Darwin.
Yeah, that's the only idea I had. Blue chip for 750 in Darwin, perhaps is the way people are looking at it. Let's go to rents because there's been a little bit of a surprise with rents, and some commentators suggesting that it could feed its way into the CPI data for inflation because housing costs are a big one. The rent bucket is a big one. Starting with you, Dave, what have we sort of seen in terms of the uptick?
Yeah, so we've spoken about this the last couple of months, that the national rental growth has picked up, and that's continued through August, where seasonally adjusted terms had increased by another 0.5%. So it's the largest month-on-month rise in rents since May last year. So what's that, about 15 months ago? So the re-acceleration in rental growth has been apparent through most of 2025 now. And so that has caused the annual change in rental growth to now hit 4.1%. And as you touched on, this will feed through to CPI at some point down the track. So it's one to watch, because if this keeps increasing, it does mean it's less likely that rates will fall much further. So yeah, there is more than a year lag between rental value estimates and the CPI rents paid. So it will take a while for that to come through into affecting inflation. But obviously, these ridiculously low national vacancy rates at 1.5%, which is around record lows, are just, causing rents, even with our coming out of this sort of living crisis, affordability crisis, rents are still seemingly, rising at a solid pace above where inflation sits. And just for a bit of perspective around vacancy rates, for the 5 years prior to 2020, the recorded average vacancy rate was 3.3%. So that's more than double the current level.
Put that into context for us, Cate. 3.3%, the 5-year average pre-COVID. We've got some different prints from Cotality and SQM in terms of the vacancy rate right now. But where are we sitting, and what implications does that have for rentals and landlords?
So at the moment, depending on which city you're in, there's a bit of a variation here between houses and units. The lowest on both counts is Melbourne. We're at 1.1% and 1.5%, which means that Melbourne rental growth is not keeping up with target band inflation. So right now, renters have a better outlook in terms of rental increases in Melbourne than in any other city. And who knows how long that will happen, that will remain for. And we can see that Melbourne in housing market has ticked up marginally since last month. But back to your question, where does that leave renters? Well, our pace of growth has slowed down, but you wouldn't want to be a renter in Darwin. We've got 6.5% for houses at the moment as the annual change, and 9.4% for units. Now, I remember when we hit double digits for unit growth in Melbourne and everyone was screaming. Darwin's experiencing that now. But we've always talked about rental growth, with Pete Kalizos famously coining the fact that we were playing catch up. And we had miserable rental growth for a long, long time across the board, but particularly in cities like Melbourne and Sydney. Melbourne traditionally has had a 3.1% yield longer term, and we're suddenly up to 3.7, and landlords are enjoying a little bit of a better balance to their cash flow and their economy when it comes to holding a property, despite the fact that the tenants have felt a lot of pain with that figure having been dragged up from 3.1 to 3.7. But it's still a negatively geared or a negative cash flow scenario for most owners. So unless you're in Northern Territory, you're probably having to contribute money from out of your own pocket to keep your investing in balance.
I want to move on to listings, but just to throw something to you, Dave, quickly. When we saw the rise of Perth, we saw rents increase at the same time, a sea of investor transactions, which seems a bit counterintuitive. You have a sea of investors coming into the market. You think renters would be spoilt for choice, but that data tends to take quite some time. It was, a solid year or so before we saw the rental growth start to dissipate in Perth. Darwin is that market that's charging away, and Darwin is the one that's seeing that growth. Like, what do you kind of put that down to? I'm wondering if these are new transactions, these are properties that are more likely to go on the market at market rent, whereas if they're existing properties, it is relatively common for investors to be charging sub-market rent if they're not having the turnover. Do you think that explains it, or am I missing something?
Yeah, I think we had a little chat on this a number of months ago, and I think that seems to be what it must be, that these new investors take over, whether it was a previously an owner-occupied property or an investor property, but where the landlords had got a bit lax on what they would charge their tenants because they were happy with the tenants, they'd been there for a while, they didn't want to rock the boat. And it seems as though you get these rental increases at the same time, don't you? Even though it's counterintuitive when a new market's taking off. So, yeah, it'd be great for someone to do some analysis on this and clarify if our theory is correct. Might be one for you to do with Kent, or for me to do with Kent or something. But yeah, that seems to be the most logical explanation, doesn't it? What do you reckon? Is that what you think?
That's all I can think of.
Yeah.
Cate?
Oh, unless there's some project going on that we haven't taken into account. Let's keep it in focus. Darwin is a small capital city compared to the others. It's smaller than a lot of our regional cities. And so if there's a really big project going, or an employer that's increased jobs and is catering to people who can't be FIFO, that might explain the pressure on rents. Outside of, and that would be coincidental. Outside of that, I can't think of a reason.
Sticking with you for a second, Cate, because I want to talk about listings. It's a tale of two stories in some respects. We're seeing the flow of new listings increase to some degree, but we're also seeing a decline in total stock levels. And there's been certain situations where I've spoken to you about, okay, well, people aren't putting their house on the market because they don't know where they can actually go to next. And that's kind of paralyzing the stock, and it becomes this kind of a robberous of self-fulfilling prophecies. How does it feel on the ground in Melbourne when it comes to stock levels?
It doesn't feel like we've got our spring array of stock yet. And I have to keep reminding myself that we're only in early September, and it won't feel like we've got our stock volumes hitting full throttle until after the footy is behind us. And that's the genuine reality of spring markets across quite a few areas. I'm not just going to say Victoria. I've got to get over the fact that VFL became AFL, but we certainly do have a city that stops for footy. And I think that we can anticipate seeing October listing numbers, pumping through soon. Agents are talking about higher appraisal activity and having auctions locked in. I'm getting a few less pre-market opportunities now than I did this time last year, but there's a reason for that. Last year, the owners that were taking their properties to market in October, November, December, they were really happy to. Well, a lot of them were happy for agents to share the photos and the details of their properties with buyers agents, and maybe sneak in a sale before they take it to market. Our market's moving now. This time last year, it had been static for a long time, and vendors weren't sitting there trying to time the market. Right now, every vendor that's planning on selling is just looking at what's going on each week and saying, well, the longer I can wait, the more I'm going to get. And that's our issue. It creates a chicken and egg, with quite a few vendors saying, well, I either need a really long settlement with a lot of flex so that I can buy my next property, or I won't list until I've found the right property. And the fussier the brief, the harder it is to get that vendor to sell their property, because if they know they're searching for something rare, they'll be reluctant to sell and be homeless, especially in a moving market.
That's a good point. And one man I know definitely stops for the footy is Dave Johnston. Pies are in trouble, I think, and we won't talk about that too much before we get.
No, they're not in trouble
from non-Victorians.
They had an amazing win in Adelaide last Thursday night.
Where were you, Mike?
Straight through to the preliminary final.
I don't know.
One win from the grand final.
I googled AFL season ladder, and I can see in the last 5 games they've lost 3 of them. So that looks like trouble to me. Whereas the mighty Geelong Cats, 5 wins on the trot.
Well, Geelong are premiership favourites now, and Geelong and Collingwood won
in the semis.
Qualifying finals. They're both into the preliminary final, is its technical name, and they're both 1 win away from the grand final. So. All smiles
right,
here,
we're
Mike.
Teetering on the edge of orange card, or yellow card,
Cate
but
getting nervous.
Yeah,
well,
I know.
It's time for me to jump on the wagon at the last minute. But
what I will say though, just one thing on back to the footy and how it relates to property. Try and get a deal done in Geelong right now after 1:00 on a Saturday.
Is that right?
It's really hard.
I learned in my brief studies of contract law, there's a number of reasons why a contract can be void even if signed. One of them is duress. You can't hold a gun to someone's head. Another one is incapacitation, which also includes, as what Kerry O'Keefe would describe as being munted post-football. So you're not able to sign a contract to buy a house if you've gone to the footy and had a few cans. Is that what we're talking about there in Geelong?
Pretty much, yeah.
Right.
Well, I think when we did the stats, it was a ridiculously high percentage of the population were members of the football club.
Absolutely. They're just so ingrained in it.
It's a
I ring up, I've seen this property. It looks awesome. Do you reckon I could get through in the afternoon? Nah, come to the open. Vendors only doing opens. And it's probably true. It's not just the agents that are saying, I want to go to Cardinia. It's the vendors as well.
That's weird. Yeah, it's a completely different thing you guys have got going on down there. Dave, let's look at listings across the board. It's a mixed case, and I love looking at this data with an idea about what predictions we have for the next little while. If we look at total property listings, we've seen a big contraction in Darwin and Brisbane for the year. Melbourne's had, 11.5% change for the month is maybe an indication that the spring stuff is coming for Melbourne. What are some of the big takeaways for you when you're looking at this data?
Well, yeah, when you look at this data, the monthly change, it's all about we're going into spring. So if you're looking at total listings, you want to look at the 5-year average, see how things are looking, because people just don't sell in winter, even though they should, because they have more buyers relative to the number of properties. So it's a good time to sell. We talk about this every year. We've been talking about this for 20 plus years. Spring is not a great time to sell because you've got so much competition with other properties relative to the number of buyers. The number of buyers doesn't fluctuate as much as the number of properties for sale. So, people think because it's getting sunny and the birds are singing and the flowers are blooming, they should be selling, but it's actually the opposite. So it's what it's worthwhile looking at is the yearly change in these numbers here. So we can see Brisbane over the year, total property listings is down 11%, Darwin down 36%, Melbourne and Hobart are down 5%. So that's a bit of an insight. We know Darwin has performed really strongly. We know Brisbane was the best performer last month, so that's totally aligning with total property listings. Interestingly, Melbourne and Hobart are also negative in that space. Now, that possibly is because they've been two of the weaker capital cities, so people are holding off selling. So, is that going to cause a turn in the prices for those two capital cities? In terms of new listings, interestingly, Brisbane's yearly change, is the biggest there, down by 15%. And maybe that's because you've got the Brisbane Lions, the Gold Coast Suns, and the Brisbane Broncos all in the finals. So no one wants to sell. Back to the footy impact that we're just talking about. It actually could be. I mean, that's the first time ever the Gold Coast Suns have been in the finals. Those two teams play each other this weekend for the first time ever. So look, maybe that's people are so interested in not only just the rugby league but also the AFL up there. So look, there's some of the stories that potentially are being told through the listings.
Yep.
Yeah.
Cate, when we look at old listings, to summarise that for a 5-year-old, Canberra bad, Darwin good. What do you reckon?
Yeah, actually, Darwin is really the only standout. I mean, Brisbane's got a marginal annual change at 1.5%. Darwin, though, let's keep this in perspective. Again, I've used the P word a lot for Darwin, but we have to remember it's a small city. We're talking about 329 available old listings versus 694. So I wouldn't write a book on that. This is not thesis material, but it certainly shows that there's an appetite for stuff that's been floating around on the market for more than 180 days. Everything else is up, and not slightly. I mean, Canberra, yes, that is bad, but again, it's still small numbers of sales. We're talking about 953 versus 580. And we don't know what these small crummy sales are. I mean, that could be 3 bad high-rise buildings selling studio apartments that no one wants. So again, the data tells you only so much. Once you start getting into the smaller cities, the old listings and the distressed listings aren't all that reliable.
Yeah.
It does sort of speak to some heat in the Darwin market though, right? I mean, we've got a 10% drop in new listings for the month, but still 31% increase in new listings. But yeah, the old listings have contracted. So it does sort of seem like the power is with the seller at the moment, just based on the fact that the news is out. Darwin has been outperforming despite slightly being beaten in the August data by Brisbane, for example.
Yeah, that's right.
One piece of data that was really interesting with Darwin is the amount of financing to investors in Darwin has doubled from 12 months ago.
There you go. Because like Darwin, I mean, we've been looking at property markets for quite some time, the three of us combined, and I've never really seen Darwin appear as a hotspot. Maybe 2007 from memory.
Long
there was
time
some
ago.
Yeah,
It had a
LNG
good time with
projects.
Perth. Yeah, Darwin and Perth were the stars for a while back there, but Darwin, it didn't have a long and sustained period of growth like Perth did.
No.
But it did what it's doing now. It's surged.
Yeah, interesting one to watch. Let's go to sentiment and the economic conditions for the next 12 months and the next 5 years have surprised on the downside. There's a little bit of depression about economic conditions for the next little while. Cate, what's a big takeaway for you there?
Yeah, the big takeaway is that we haven't seen an improve. So we've just been gifted an interest rate cut that's absolutely stimulated my local market. And I'm looking at this consumer sentiment chart and scratching my head because it's not at all suggesting that it's aligned with what I'm seeing on the ground. However, it's a bigger sample size for sure. Economic conditions for the next 12 months and 5 years, my question to myself is what would be causing that deterioration? And they're not modest deteriorations. It's almost 9% and 6% in 1 month. What would be causing that? What's happened that's made people say, wow, things are going bad?
I think global conflict has to weigh into that to some degree.
Yep.
I mean, because we
Yeah.
are in an interest rate kind of cutting cycle, so I feel like there's been some escalations with Ukraine and Russia. I mean, China's just done its military parade with AI dogs and wolves, and Dan Andrews came in to just sort of say hello from one dictator to the next. Just a fan of your work. I mean, how has that been received by Victorians, that your once esteemed premier, the captain of the Ring of Steel, is over there admiring some of their best dictatorial work?
Yeah,
I think it depends on which side of politics you sit and how far you sit to the left or right, I'd say.
Oh, this has had so much airplay this week.
Yeah, most people don't love it, it'd be fair to say.
Back to the challenge that we face at the moment. We've had, obviously, the war in Gaza has just been enormously ugly, and it's got worse. We haven't had too much out of the States in the last few weeks that might have had these figures tumble. I really did look at it and scratch my head, though, because I don't think it's just one thing. However, when we look at the additional cash flow that a lot of us have with relief with our mortgage rates, it was something that stood out to me as a bit of an anomaly.
Yeah, it does sort of seem like there's been a few extra incidents. I think Israel have asked the Gazans to evacuate because they're sort of mobilizing some troops in there. And we're seeing a lot of unrest in Australia with the pro-Israeli or pro-Palestinian riots or protests that have turned into sort of violent confrontations. We've also got the anti-immigration league, the pro-immigrations. There's some white supremacists getting around, causing all sorts of fracas as well. It's definitely an interesting situation to observe, and hopefully we see a de-escalation of tensions. I don't think it's good for anybody, but we'll leave.
Yeah. Look, I guess
we know it's not good for markets. That's one thing for certain.
Yeah, I mean, we've had some really horrible events in Victoria. Victoria and New South Wales are basically about half the population. If they're being, the psyche of the Victorians and New South Wales, Welshmen and women are being impacted by local matters as well as international things that are going on, like you've spoken about. That those things cast a pall over people's perceptions of the world, and that then flows through to how you feel economically, I think. And so I think that is what is going on. What is going on there, despite, as you touched on, Cate, we've recently had that rate reduction.
Yeah, and we've still got fairly confident house price expectations and fairly confident interest rate expectation index as well. So I think across the board, we broadly believe that we're going to be okay. It's just a pretty pessimistic month. Before we
just a few interesting numbers in there, just digging into the detail a bit. So what I talked to most months for a long time, just in terms of the time to buy a dwelling index. So it had a bit of a bump and then stayed at a similar level. So it's at 96.1 in September. It was 97.8 last month, but that was after a pretty sizable bump. The most positive sentiment on now is the time to buy a dwelling is in Victoria, because that would mean you would think that Victorians think, oh, it's pretty affordable here and it's staying relatively affordable. You'd think at some point that means a dam will burst and prices will start rising faster, but we've been saying that for a while. But Victorians have that index at 110, which is the highest of all the states, whereas the big three, Queensland, Western Australia and South Australia, are the lowest. 82 for Queensland, 74 Western Australia, 91 South Australia. So they're all thinking, gee, prices are so high, it's not a good time to buy a dwelling.
Yeah.
Interesting. Yeah, that's great to get that segmentation down to the state level, Dave. Into another area of your expertise, let's talk about lending and housing finance. You mentioned Darwin seeing a huge increase in investor-led finance, but what are the key stories for lending, especially on the back of the announcement to bring forward the first home buyer incentives into October? It's interesting, a lot of people reporting about this new incentive. It was always coming, it was just next year, but it's been brought forward.
Yeah, I think the politicians have realised the impact of people knowing there's the start date of 2026 and getting in, and investors getting in, people getting in before the market moves. So they've brought it forward to October 1, and they've also increased the prices that people get that government boost on as well, which I don't have right here in front of me, but like Sydney's price point, and I assume they've linked this to medians of the capital cities, or they're just favouring certain cities. But Sydney's price point has jumped to 1.5 million. I'm not sure if you guys saw that.
Yes.
Yes. Yeah, that's big.
Poor old Melbourne, it's reflecting our lower median is only at 900, and Brisbane's, first home buyers can get the benefit of the federal government assistance up to $1 million, so $100,000 more than Melbourne. So, I think that's definitely going to have an impact on markets. And one of the things we saw with first home buyer loan commitments for dwellings rose 1.7% in the quarter. But I expect that to rise a fair bit more in the coming year.
I've seen a really significant change in this segment since that announcement, and a lot of people are very fearful that the 1st of October will mark a huge run on a sub $950,000 stock in Vic, and sub whatever the figure is in every state.
Yeah.
And there are a lot of first home buyers who don't need the 5% deposit guarantee because they've either saved a lot of deposit themselves, which is more unlikely, or they're using their parents' equity. They're getting the parental loan guarantee anyway, and they're the ones that are saying, let's quickly get in before the herds. And I've seen an enormous push there, but by far the largest contingent are investors. They're saying, get us in before the first home buyers stampede. So I've certainly seen a change in attitude and volume of buyers in this space just since that time. It's been quite surprising.
It almost sort of doesn't matter exactly whether a policy is going to have an impact. It's just what people think. And if enough people think that it's going to have an impact, then we're dealing with the results of that herd mentality rather than any exact fundamentals, right? And I think that's a conversation that we've had about the property market in the last couple of years. The fundamentals might sort of say a location has no legs, but if there's enough people going over there and transacting, then those legs can be created by virtue of the perceived idea that it's going to do something.
Well, the 5% deposit scheme makes it possible for a lot of people that either weren't pressing hard enough when places were limited, or that they hadn't realised that it was available to them. So what we've done is created an additional demand, or we've had a demand that's been pushed forward, and we've created more buyers in this time frame than what we would have had if we didn't have this offering. Now the supply stayed the same; it's just the demand that's increased.
No, I certainly do believe it will be stimulatory. I mean, if we just look at the numbers, I mean, normally we're talking about caps of 40,000 people would qualify for this. It's now uncapped, and depending on the year, we're sort of seeing around about 130,000 100,000 first home buyer transactions a year. So that means that more people will qualify for that, and we should probably expect an increase in those transactions. I was chatting to ABC Radio yesterday about what I think for this, and very simply, my idea is that it's great if you qualify, and it's just gotten harder if you don't, or if you miss it from a timing point of view. So if you're not ready and you're still saving for your 5% deposit or what have you, by the own modelling of the RBA, it does increase prices. So it begs the question, are we continuing to kick this can down the street from affordability by putting these front-end stimulatory measures in place to help people to get into the market? Or are we going to have a meaningful conversation about supply and development and, more importantly, the state anti-mobility taxes like stamp duty, for example? What do you think, Dave?
I think the states are certainly, and the Minns government in New South Wales is probably one of the leading proponents of really trying to drive supply and into inner suburbs, trying to keep it around train stations. But that is the real battleground, because you're getting pushback from local members, local constituents. But he's pushing hard. I think it's just going to continue. That we will create more supply. Governments are going to be under more and more pressure to do so, and it's going to become more commonplace. Not everyone's going to love it. Hopefully it's done tastefully. But whether that, that's going to take years to create a culture of that, high levels of supply matching demand. It's not going to happen overnight. Are we going to keep throwing stimulants to first home buyers? I think that's the answer to that remains yes.
Yeah. And we'll never take them away, ever.
Yeah. And are we going to transition to land tax, which is much more, is a much smarter form of taxing property rather than this huge impost at the time of purchase, which we call stamp duty, which the governments rely on so much? I think it's very unlikely, even though it should happen. And the New South Wales Liberal government did start putting something in place, which the Minns government then just quashed, as soon as they got into power. So I thought that might have been the beginning of a transition to land tax, particularly if New South Wales, the biggest state, had started sort of rolling that through. But when the Minns government shut that down, it made me less confident about that occurring one day, or at least in the near to medium future. What do you both think?
I think we really need a rethink on the way states are funded, right? Like they have the GST revenue, they have the land taxes, they have the stamp duty, but the property taxes are the majority thing, right? So we kind of do need to rethink a way that we can get the states hooked or off the fact that they're hooked on the drug of these property taxes, because they are an impediment to supply. I don't know. What do you think, Cate?
I think that either option, Dave, has a bad like a negative. There's no perfect solution here, whether we revert to an annual land tax or we keep the nasty stamp duty. But what I will say is, typically when you buy a property, you're qualifying for a loan and you're earning an income. If I had to pay a hefty land tax bill every single year into retirement, I wouldn't feel so great about that if my retirement funds weren't looking good. You don't want to see older Australians having to sell because they can't afford their annualised land tax bill. So I think
some people do want to see them sell. Some people do want to see retiree, who are asset rich.
So let's say they're not
cash flow.
Let's say they're not. Let's say they're not asset rich. They've for whatever reason they've. But if we look at
different cohorts, isn't there? That's the thing.
Of course.
That's why there's so many different opinions.
The more vulnerable ones.
Yeah.
We'd be creating a scenario where if we look at the average Australian's wealth position, especially for our retirees, that a lot of them don't have a great outlook, and some of them have got just enough in their super or their savings to get them through the rest of their life in a comfortable fashion, not an extravagant fashion.
Yeah.
And I think it would cause a lot of heartache and a lot of distress for the families that don't have the capacity to pay thousands of dollars additionally each year in land tax. And that's the magnitude of what it would be. Even if it was $1,000, it's still a big hefty hit for someone who is counting their pennies.
But it's sort of also the problem with today's politics is it doesn't matter what decision you make, you're going to negatively impact some group of people.
Someone.
And now we're at the point where our politicians make no tough decisions because they don't want anyone to have to pay a price for the greater good. And so we're just down this spiral of more and more debt and trying to please everybody. And it's putting great pressure on our economic prosperity, on our standard of living, which is going backwards. I think it'll be having an impact on our productivity, which is the key ingredient to increasing your standard of living. Full stop. It's the driver. So, I agree with what you're saying, but I think land tax makes much more sense than stamp duty. Also, future generations will have had the benefit of superannuation for the entire working life. So in theory, they should have more of a nest egg. Yeah. But it's a vex, you can't please everyone, can you?
Something has to give, doesn't it? And there's sort of parallels with the French government situation that we've got at the moment. I think Macron has presided over his either 6th or 7th ousted prime minister who's been asking for more austerity measures. And as far as I understand, they haven't had a budget surplus since the 70s.
Right.
And the cost to service their debt is more than they spend on education or health, which isn't that an amazing insight? And, we have this funny argument in Australia that Labor are good if you want stuff. Liberals will rein it back in, but they're good economic managers. No side of politics has got us into the situation where servicing our debt is a bigger expense than our education or our health budget. So I think there's probably a lot to be thankful for there, other than the fact that we're not French.
And the debt's increasing. So the interest
Just,
is as well.
Circling back to that land tax versus stamp duty argument, what would happen to prices right now if we reverted? I know what would happen. People would all of a sudden have a lot more money up their sleeve. And while we've got the 5% deposit guarantee opportunity, have a look at what would happen to upgraded properties. They're not eligible for that guarantee. That all of a sudden have significantly more cash on hand to throw at the property.
I think that's an initial reaction of what would occur. But then in the long run, the one of the key arguments is the mobility factor. People will sell more readily, and therefore you'll have more stock on hand, and therefore prices will moderate. Price growth will moderate, and therefore be more affordable.
The big question for me is what would happen to the household formation rate? Are we going to see more or less people per dwelling? Because that's an underrated supply mechanism. If we can just have an extra person per dwelling, I mean, that's like building 300,000 homes, I would guess, right?
Yeah, but how do you make that happen?
Well, you've got a hell of a lot of people jammed into one room at the moment, Dave. Like, what would one more be if I came to live at yours?
Well, I mean, sure, it can happen with necessity, but mandating it as a government might be moving the bar a bit too far.
Slippery slope. We've gone way off topic. It started with football. I blame Victoria. Starting with you, Cate, is there anything that sort of stands out for you that feeds into property and property prices and the predictions we can make from it?
Yeah, unemployment's stable, and that's a good thing. But what it means is that some of the pain we thought we'd have to swallow is not yet on the table. The wage price index rose in the quarter, and when we separate public and private, there's a bit of a discrepancy there. But I think the It is. I'm going full speed right now because I'm mindful that we're about to clock an hour and our listeners will tune out. But GDP was the concern. It rose and we weren't expecting that. So after we had our interest rate cut and everyone was excited, all of a sudden this data came out and said, hey, hang on, do we have to start getting a bit worried again about inflation running away from us? Early days, and it's not a massive increase, but it's an increase. So I think the RBA will be keeping a really close eye on that one.
We've gone from almost a guaranteed cut to, hold on, let's just have a look at some stuff before we sign off on that one. What do you say, Dave?
Yeah, well, certainly the markets are suggesting we won't have a cut at our next meeting. That's down at, I think, 16% likelihood. And the 3-year bond yield is sitting like half a 25 basis point reduction below our current rates. So they're saying, look, rates are likely to, over the next 3 years on average, be around where we are right now, maybe one more cut below. So, yeah, people are second guessing whether rates are going to fall much further.
Yeah.
Well, before we put a bookend on this, anything else that stands out from the two of you?
Only the fact that we've just about clocked an hour.
I know. Well, I'm going to sneak us in very skillfully by avoiding any nuggets because I feel like we've given a bunch of those. Dave, what do you reckon?
Yeah, no nuggets for a market update, but just two little quick tidbits. Canberra cracked the $1 million mark for the median value for houses for the first time, so it's up there with Brisbane and Sydney, above $1 million. Melbourne sitting at 956, and the Perth median for units moved into third position above Melbourne at 624,000. So Melbourne continues its slide down the rankings.
There you go. The more the Liberal Party fight with each other, the better Canberra does. Isn't that funny? And we'll take that opportunity to close off the month that was the month of August. We look forward to bringing you September and October in the next little while. Stick with us. We'll keep you informed. We've got lots of great episodes coming up and some listener questions to look out for. But it's goodbye from the trio, and we'll see you next time.
See you later, guys.
See you later.